This is Seattle's Morning News. Dave Ross with Colleen O'Brien and Chris Sullivan. I'm sure most of you remember Washington Mutual Savings Bank. There's actually a big Washington Mutual building downtown. It was at one point the nation's largest thrift institution. It was built up by Kerry Killinger, who's the CEO, and then in 2008, during the financial debacle, it was seized by the feds on grounds that it was insolvent. Except, Kerry, it's in looking at your new book, which is called Nothing is Too Big to Fail, you feel the bank was stolen.
Well, good morning, Dave. Thanks for having us on this morning. You know, we decided that it was so important that there were some misunderstandings about what the real facts were, what happened back in the last financial crisis. And we said, you know, we better set the record straight and put out all the information that we know and a lot of the records that we had and access to information that just others didn't to get the true story of what happened during that period. And the primary reason we wanted to do that is we think the feds are once again taking us down a position of severe risk in the economy for a potential another bursting of bubbles like the stock market and housing and the like. And we figured that the only way they're going to learn so they don't repeat some of those same mistakes is to get a lot of those true facts out there.
Okay. And I want to hear what you have to say about the current economy, but you'll need to clear up a few things because there are a lot of people who are still angry with you. I mean, you've been sued over this, and I understand why you want to write this book to set the record straight. So tell me what your position is on the failure of Washington Mutual. Did you try to hide any assets or hide anything that the bank was doing wrong?
Oh, absolutely not. And first of all, we strongly believe the bank was unfairly seized, and it was not a failure and should not have happened. Let me just give a couple of very quick factoids. One, similar to today, where we see risk of a housing bubble, we started warning the feds, the Federal Reserve and the major regulators and our shareholders and everybody else about 4 years before the financial crisis that housing prices were getting too high and that we were in for some form of a correction. And we actually reduced the amount of residential lending we did before, leading up to the financial crisis for those 4 years by some 74%. We almost got out of the business. We cut out all the higher risk lending like subprime, which was always a small part of what we did, but we reduced that to nothing. And we showed that our loan delinquencies were about half what the industry was. So our loans were performing well. And the bank in the middle of 2008 had the highest capital ratios of any large banks in the country.
So you left it in good shape is what you're saying.
We thought we were in excellent shape. The problems, we got caught in the crosshairs. One was there was a rapacious appetite on the part of J.P. Morgan Chase to acquire the company. So they were very aggressive in trying to work, and some would say manipulate the regulators into helping them out. And then we got caught in the second part where Treasury Secretary Paulson said, policy-wise, he wanted to eliminate community banks and thrifts to the benefit of Wall Street. And then third, when the crisis finally hit, and everybody panicked, there was no game plan.
Did we at least learn a lesson from it such that it won't happen again?
Yeah, I think the lessons learned from this is that whenever we get in these periods of encouraging asset bubbles, like the Fed did leading up to the last financial crisis, they kept interest rates below the rate of inflation for an extended period of time. And guess what? Housing prices rose at an unrealistic level. And I'm hoping we have learned from that because that's exactly what we're seeing again today. The Fed has kept interest rates way below the rate of inflation. Naturally, that led to easy affordability for housing, and people are just bidding up prices all over the country. So we all have to think about what's going to happen to the prices of those houses when interest rates return to a more normal level.
Most of us don't understand this, the banking business and how it works and how the stock market works and how Bitcoin works. But when people hear someone with your experience say, we're seeing another bubble develop, I think the first thing to think of is, wow, what do I do to protect myself this time? So for ordinary people who were just sitting on a modest savings account and are thinking of retiring someday, how would you suggest they protect themselves if indeed we're heading towards another 2008 style bubble?
So I would be diversified. I'd look at assets not only in the U.S. but around the world, and try to be sure that you're not just dependent on one of these areas that might potentially be a bubble. I do think for most people that may own a home, again, I would certainly try to lock in lower interest rates for as long as I could. Because, again, I think interest rates are going to rise at some point. And so kind of locking in a 30-year fixed rate mortgage is probably a pretty smart thing to do. I think it's going to be increasingly important to put as much of your funds into retirement plans as you can to be sure that when it's time to retire, that you've got the flexibility to do it. And to also think about long-term investing anytime you're doing things. Don't get caught up in the hot stock of the day and the like. Try to think about what are those things that can perform okay over 3 to 5 years.
So you wouldn't recommend plunging your savings into Bitcoin then? Huh?
Well, again, it's very difficult for me to opine on any single investment. I try to look at every asset that you can invest in, be it housing, stocks, Bitcoin, anything else, and try to make an assessment about what is the current price of that versus its underlying inherent value, or we call it intrinsic value. And sometimes current prices are way below that intrinsic value. Sometimes they're way above it. It happens to be today, many assets are above what we think is a reasonable intrinsic value. And that always indicates kind of flashing lights for some risk. This is perhaps the riskiest period I've seen in my lifetime in terms of so many asset prices rising to record levels, speculative activity coming in with a frenzy. And the system being so leveraged with the federal government at record amounts of debt, corporations record amount of debt, consumers in many areas at record levels of debt. Whenever that happens, that's just saying that's a high stake risk. And I think the risk reward ratios of plunging into some of these is not very good right now.
Nothing is Too Big to Fail is the name of the book written by Kerry Killinger and his wife, Linda. And thank you for the warning. And I hope you're completely wrong. But none of us can now say that we haven't been alerted to what might happen. Thank you very much.
Thank you, David. Appreciate it.
We spoke for about 25 minutes. We'll play some more tomorrow, and then it'll be a Ross Files podcast at mynorthwest.com.